Hello, everyone. I hope you're doing exceptionally well. Today, we're going to be talking about buying term plus investing the difference versus the big bad IBC. So, the this conversation comes up a lot, and you've seen it often when you talk about the difference between whole life or permanent life and just regular, good old term insurance, and what is actually better. So, first of all, I'm going to preface this by saying that I don't think that somebody should be participating in the infinite banking concept for the sole purpose of having insurance. I believe that if you are just trying to buy insurance and that's all you want, term is great. Term is lovely. There's a lot of use cases for permanent insurance. Don't get me wrong. There's nothing wrong with term insurance. The thing is that somebody who's considering the infinite banking concept really shouldn't really worry about buying term and investing the difference, because the idea that somebody who's looking to practice the infinite banking system in Canada should be wanting safe, liquid access to their cash at all times and to efficiently use their capital in the most efficient way possible, to preserve their capital, to have it safe, to remove the banking equation from their life. And what's the banking equation? Well, the banking equation is that when you need money, you go to a bank, you ask them, they either approve or deny you. They make you jump through hoops, and then they either give you or do not give you money. The idea behind the infinite banking concept is to remove that necessity from your life entirely. So essentially, when you need money, instead of going to another bank, you're going to your own bank. So, first of all, I will basically state that the difference between buying term and investing the difference versus IBC is really comparing an apple to an orange. They're two very different things. However, we're going to run through this exercise because, in reality, at the end of the day, um, you're really not getting uh, a much different result as you would otherwise potentially perceive that you would be. So let's kind of break this down. So what I've done is I've run an illustration, two illustrations. So one is term plus invest. The other is an IBC, properly structured whole life insurance policy. One thing I do have to say here, I am not an insurance advisor. I am not a licensed individual or financial professional in any capacity. I'm just simply here to educate people on the infinite banking concept. Okay. I practice the infinite banking concept. I have nothing to sell you. I'm not trying to convince you of anything outside of this concept that I think is great. So, what I've done, I've said a 30-year-old, okay, in good health, looking at insurance. So we're going to cover the premium, and then we're going to cover the death benefit and look at what can end up happening. Benefit, man, I can't write. Okay, so essentially, in order to get $250,000 of coverage on both the infinite banking concept and in term and invest the difference, right? The premium for a term policy would be about $350 per month, uh, per year, rather. In the infinite banking world, $250,000 of coverage would be 10 grand a year. Remember, the idea is you're trying to maximize the cash value and reduce the death benefit as much as possible to essentially have as much cash accessible. Now, remember, one of the the key examples of the infinite banking concept for people that do want insurance down the road, and it's a good side bonus, is that this will continue to increase, and you'll see that this is going to. I have illustrations below. So the idea is you take the difference between the two, which is $9,650. Okay, and we're going to invest it. Now, here's some assumptions that I've done. I said the individual investing this money is going to get 6%. Now, why 6%? Well, um, because there was a study done recently, and I'll get the final link for it. I'll put it in the description below. That says that the average investor um, basically got like a 2% return or something like that at the end of 20, 25 years of investing, just because of human behavior. The stock market has averaged 8 to 10% over the last 150 years, but I don't think anyone would argue that the returns that we've seen in the past just simply aren't the same, because we're seemingly having more. Crisis events, at least economic crisis events, more frequently. So 6%, I think, is a fair go between the two. It's not, 5% right in the middle of 10%. I'm giving it its fair shot. I'm saying that there is no fees. associated with this 6%. So we're just going to say it's a 6% return. I'm not accounting for inflation or anything like that because inflation would impact both of these things. Okay. So I hope this makes sense. So let's scroll down and actually look at the difference. Okay. So on your left here, you're going to see the buy term and invest the difference. You've got your 9650 that's going in, your 6%, compounding it annually. You're investing it for 30 years, is what I've said. You're contributing it at the end of the year. You save up the money, you invest it, and you're contributing it on a yearly basis. At the end, you have $762,000. You've contributed, well, 28, $289,000. Okay. So here's the thing. You are at $762,911.50. You have to remember, a lot of this is going, well, before we get there, let's look at the insurance policy example. At the end of 30 years, age 60, you'll have $617,000, 358 bucks. You'll now have $1.3 million of permanent life insurance, which means that if you chose to stop making payments right then and there, you no longer need this insurance. So one of the cool factors with IBC is if you start it soon enough, it actually grows with your life and as you acquire things. Everyone says that you don't need insurance as you age, but kind of with the curve of purchases, right? You need very little insurance through your teen years and your 20s. Then you acquire a whole bunch of assets through your 30s and 40s, and then slowly over time you end up paying it off, right? And eventually you're what's considered self-insured according to everyone. Well, the thing is that takes a very, very long time. If you buy a house in your 40s, a 25-year mortgage, you're going to need insurance into your 60s. So anyway, and not only to add, but your highest earning income years, meaning the most impactful to your situation if one of the incomes were lost, if I recall correctly, is your mid to late 50s. Which means your need for insurance actually increases quite far into your life. Okay, so now let's erase this really quick, this little graph of insurance needs. So now we are comparing $762,000 versus $617,358. Okay. Now one would say, okay, well, wait a second here. There is literally what, almost $140,000 of difference. Okay. Remember, this, if done properly, is tax free. All right. If done properly. Okay. You can access it, use it, no issues without any tax consequences. There's a few different manners. Some of it can be tax sheltered. Okay. Some of it may be tax deferred. All right. And some of this potentially, depending on how you use it, could be tax deferred as well. But if you use it properly, it's going to be completely tax free. So you got tax sheltered, going to be tax deferred. But the reality is most of it, I would argue, is going to end up being either tax deferred, which means it's still taxable. All right. And typically speaking, it's going to be taxable in one of two ways. Either it's going to be in an RSP, which is taxable at your income rate, right, as income, or it's going to be capital gains. Now, the thing is currently capital gains, 50% of the income is taxed. If anyone's been following the news lately, they would know that the Liberal government has recently considered increasing this to 75%. Now, it didn't pass in this budget, but that doesn't mean it won't pass in future budgets. And with everything that's going on with the pandemic, it's very likely that they're going to have to raise taxes somewhere. Okay. And by the way, historically, insurance contracts, once they're written, they grandfather in old contracts for tax laws, and they only open on new ones, which means that basically the tax laws for insurance for existing owners has not changed. Okay. If it's a tax on income, it's a tax at 100% based upon how much you actually withdraw from it. All right. Let's assume the best case scenario, okay, in that say 50% of the gain, the $473,000, is actually taxable. Okay. Well, that still means that good $200,000+ ends up being taxable, which is more than the difference. So ultimately, when you look at it, you will come ahead in buying term and investing the difference. But after 30 years, the difference after taxes might only be in the low tens of thousands. What I mean, 10, 20, 30, 40-ish thousand dollars. Now, you might say to me, well, wait a second, $40,000, that's a really big difference. But remember, you have not taken any risk on this side. There's been no risk. And on this side, it has. This example assumes a constant 6% return, but that's not the way the stock market works, right? The stock market typically works in, yes, the majority of years are up years, but you're going to have down years. And the thing is that one down year can absolutely decimate the expected return. What if at year 30, the stock market crashes? What if year 35, the stock market crashes and you're using this for retirement? What if it crashes at year 20 and it takes 20 years to recover from that? What if returns have been lower? So, for example, since 2000, the year 2000, the Dow Jones Index has gone from, I think, about 18,000. I'm paraphrasing here, right? But it's gone from about 18,000 to, I believe it's 30,000 right now, give or take, which means that it hasn't even doubled in 20 years, right? Um, so you have to realize that money is supposed to, according to traditional stock market investing, double at the very least every 10 years. But that just isn't what we're seeing lately. Stock market returns have decreased, which ultimately puts a lot of pressure on these investments. Okay, so ultimately, when you look at it, there's no risk on this side. So the question is, if you could, I don't want to say guarantee because there's no guarantees with anything, right? But with as little risk as possible, only be out a difference of 10, 20, 30, $40,000, but have a constant, consistent rate of return that you can go to the bank with and use with no issues, have access to it within a few days, not have to worry about any taxes or anything of that nature. Also have an increasing death benefit. You can stop these payments at any time. This still continues to grow. You can, I mean, the world's your oyster as it relates to the infinite banking concept, right? But the most important part is no risk, right? And here's the coolest part about this. Let's just pretend at year 15, they say there's going to be no more dividends issued, meaning your policy will not grow in any capacity. Well, this $203,000 that you have in this account cannot go down. So the stock market could take a plunge for 60%. And of course, your investment here would drop 60%. If they just didn't issue dividends, contractually, they cannot reduce the amount of money that you have in the account. So these are some of the pros and cons. Anyway, I hope that makes sense. Ultimately, the buy term and invest the difference argument is not an apples to apples argument. You're arguing something that has risk versus something that doesn't have risk. Studies have shown that most people don't get the returns that the stock market claims to get because of their own habits, right? Humans are just naturally flawed. So let's try to put in as many good habits as possible, such as an IBC policy, in order to basically get the returns that people actually want to get. And I should also add, you can use this money all the way through this money being grown. So let's say, for example, you have an investment opportunity. Say the market does sink 60%. Your money over here hasn't been touched, but you go, wait a second, I'm going to go dump a ton of money in here. Great. You can borrow it, right? Borrow from the life insurance company, go invest it. Once you get your return, you pay it back. No big deal. Your money's still growing. Whereas if you would do that over here, the money that you would withdraw stops compounding. Now, I've talked about that in my theory of IBC, but just know that it's certainly something to consider. I know I've got scribbles everywhere, but honestly, if you like the infinite banking concept, if you want to learn more about unique financial topics in Canada, please comment, subscribe, like, let me know what you want to hear about. Cheers.